What do you expect? I mean, what is the O'Rourke expectation of Wednesday on to say the next 3 weeks?
I think we're going to see a lot of what we've been seeing for the second half of this year is corporations talking about input prices being high. You're seeing their margins getting squeezed. And it's just overall, it's a lot of uncertainty about where the real trend of earnings is and where the real earnings outlook is.
What's the history of what we get wrong when we're in this spot? Do we get wrong down the income statement? Do we get wrong revenues or part of revenue dynamics? What's the misstep you've got your radar up on?
Well, I think the revenues are good. Like if you listen to all the companies out there, they talk about business being strong. The most interesting aspect, like we've seen develop over the past 3 or 4 weeks, is now their customers have stopped ordering because they can't get other component parts. So they can't build things. So now they've just stopped ordering for the future. An interesting story out last week was advertisers have stopped advertising because they can't make their products to sell. So I think so the revenues, the demand is there, everyone's saying. It's just you can't get the components and you can't get the products off the line in order to sell them. And that's where that's obviously becomes the whole supply chain distortion issue we're talking about.
Mike, I just want to know what to do with the banks. They've rallied so hard off September 22nd. We've got JP Morgan starting things on Wednesday, Thursday, Bank of America, Citi, Morgan Stanley, Friday, Goldman. Mike, what do you do with the banks now?
I'm still a big fan of the banks. I've been a big fan of the banks every time I've come on. I still think we're still sitting here with this low interest rate environment where we are going to see higher interest rates in the future. And I think that whole reflation recovery trade is still ahead of us. We've had about 15 years of massive growth outperformance. It worked even better during the crisis. And then about a year ago, we saw that relationship bottom where value started to come back. And then in the hiccup of the past 6 months, Ed, you mentioned how Treasury yields peaked at 1.7%, 77% in the spring. As rates came back in, the banks and other value trade components came back off, or they corrected, I should say, and underperformed growth. I think they're ready to outperform again. So we'll see when we get these bank numbers, but I'm optimistic about their environment going forward.
Do they do well on higher rates regardless of what is driving higher rates?
I think, I mean, the fact that they, in my opinion, have done very well in, obviously it's not a very flattish yield curve environment. When we start seeing some meaningful steepening emerge, I'm excited to see that. It's funny, before I came on here, we talk about policy rates. You had Jan Hatzius on talking about the economy slowing down to about 2% at the end of next year. The Fed's long-term Fed funds target, going back since they've been publishing the summary of economic projections, actually, I know it was even higher then, but I think going back to probably 2008, no, it's 2.5%. We haven't been at 2.5% since 2008. So when you think of the yield curve steepening that we're due to have eventually over time, I think it plays out really well for the banks.
So it may play out well for the banks, Mike, but what does that mean for growth stocks?
Well, I think growth stocks have had an incredible run. It's just they've been the winners. They've been the drivers of this bull market. I think we're starting to see some cracks emerge that there's probably better places to put your money going forward. Again, you look at this S&P 500, we're up 17% year to date. We've started Q4 here. There's a lot of uncertainty. These companies have driven the bull market. I think it's time for people to look elsewhere and be a little more defensive. And like I said, if you want to be invested, I would shift towards those value names.
Does that include energy? The S&P 500 energy sector up 83% year to date, still though lagging oil, with WTI up nearly 93% on a year to date basis, Mike.
Yeah, it does include energy. And there's so many interesting dynamics here because there's a very political dynamic here in the United States as far as the talk about debanking energy and things like that. You're seeing some investors buy stocks or buy the commodities, go into the space because they're worried about the shortages that we're seeing right now. And that scarcity value is making the sector more attractive. So, and then from a valuation perspective, relative to other parts of the market, energy does look good. So whether it's energy materials, yeah, I think you want to be in those spaces, for the time being.
Michael, I want to focus on what John Farrell brought up, which is the massive ambiguities of rates and inflation grinding higher. I would suggest the media makes it a very simple discussion. It's not. For people that are exposed to the stock market, list the ambiguities that can happen as we go to a new rate regime.
Well, I think, like you said, new regime is such an important, way to describe it. We've been in this current regime for probably since 2008, 13 years or so, where it's a low interest rate environment. And what we've talked about, or what investors have talked about, is there's no alternative, right? So the lower rates are, you can put a higher premium on PE, on valuations, you can pay a higher PE. And now if we're seeing this regime shift again, and it's funny, when we talk about the 2013 taper tantrum, we talked about the 10-year yield, and it gets a lot of attention, but the 10-year yield went from 1.5% to 3% in 6 or 7, 8 months, right? We're not even, we're trying to, we just moved above 1.5% here. So what happens is now you have to take your multiple down on the market. If you look at the environment in the early, the 70s and the early 80s, right, where interest rates were high, you had very low multiples. So that's the risk here is now as you start, if we actually see interest rates normalize, which we're not even close to yet, I would say we're talking about not policy tightening, but policy firming. Then you have to start taking your multiples down. And that's what put those growth names at risk, longer term. I'm not talking about over the next month or 3 months or 6 months. I'm talking about the next 5 years.